Hello again, everyone. It is I, Raging Mandrill. I just wanted to put out a relatively quick video on an issue which has been touched on. There was a Bloomberg article that came out this week, and essentially it admitted, in no uncertain terms, to be a racial discrimination against whites in hiring practices in corporate America in the post-2020 period. And you can go look up this article for yourself. There have been other people who've covered it. I'll link the applicable sources in the show notes if you want to take a look at them. However, there is an interesting connection that I have noticed from doing my own research, and this is basically from the 2008 period. I've done quite a bit of personal research into the 2008 and post-2008 housing crisis. There's a report, a congressional report by Congressman Darrell Issa of California regarding the Fannie Mae and Freddie Mac situation in the lead-up to the 2008 crisis. And we'll get into it in a second, but I just want everybody to understand exactly what the pattern here is that I'm possibly seeing. Everybody knows that the left has a patronage network at this point. Everybody knows that that patronage network is going to be wielded against their enemies. But I think it's something which can be more refined as to how it might possibly, the exact mechanism functions here. So without further ado, here goes. Scandals at Fannie and Freddie. In 2003, Fannie Mae and Freddie Mac were at the height of their power. They dominated the secondary market for prime mortgages and bought or guaranteed $344 billion of subprime mortgages, including subprime private mortgage-backed securities, MBS, and loans to borrowers with FICO scores below 660. In contrast, non-GSE subprime mortgage securitization in 2003 totaled around $120 billion, only one-third the amount backed by Fannie and Freddie. However, the GSEs were about to come under increased scrutiny as a result of accounting scandals which hammered their share prices, threatened their market share, and increased skepticism in Washington. This in turn created an urgent need for the GSEs to develop a proactive strategy using their myriad of lobbyist and political influence to blunt calls for reform. Now, of course, a GSE is a government-sponsored enterprise. That's essentially the term used by this report to denote a state-backed corporation, essentially. Those are Fannie Mae, Freddie Mac, among other state-backed corporations that serve the same purpose in the housing market. Continuing on. In 2003 and 2004, it became known that GSE executives had manipulated accounting rules to maximize profits and executive compensation, breathing new life into efforts by the Bush administration and some in Congress to properly regulate them. This, in turn, forced the GSEs to seek shelter with their congressional benefactors, the advocates of affordable housing policy. As part of their highly profitable business model, Fannie Mae and Freddie Mac both built up huge investment portfolios of mortgages and mortgage-backed securities, from which they earned the principal and interest payments. This was both the most profitable and the riskiest part of their business model. Part of the risk was that the companies had to use complex hedging operations to compensate for the inherent volatility of an undiversified portfolio of home mortgages in order to maintain the illusion of smooth and steady earnings growth. If Congress became aware of the risks they were taking, the GSEs feared it would have greatly strengthened calls to rein in the companies' over-leveraging by increasing their capital requirements. While this would have protected taxpayers by increasing the regulatory capital cushion beneath the GSE's investments, the companies opposed it because it threatened their profitability. Conducting the necessary hedging of the GSE's portfolio perfectly was impossible, particularly with prices rising so rapidly during the growth of the housing bubble. Officials at Fannie and Freddie decided to cheat by manipulating the company's earnings with improper accounting practices in order to hide volatility from their investors and the government. An internal Freddie Mac investigation revealed this improper behavior, forcing the board to promptly oust the company's top leadership in June 2003 and announced that it would restate earnings. It turned out that Freddie Mac had been underreporting earnings on derivatives and bonds that had dramatically increased in value due to the falling interest rates between 2000 and 2003 by $5 billion. Freddie did so to maintain the illusion of the steadily increasing returns its investors had come to expect, disguising the increasingly volatile nature of its undiversified investments in the housing market. The fact that Freddie's board of directors had been briefed on management's plan to massage earnings, yet did not question it, raised serious doubts about the board's motivations and effectiveness. In its report on the scandal, OFHEO singled out the presidentially appointed board members such as Rahm Emanuel, who sat on the board at the time it was apprised of the improper accounting scheme, as an anachronism which should be repealed so shareholders can elect all directors. This was a stinging indictment of the crony capitalism that led directly to lax oversight and perverse incentives for the GSEs to behave improperly. And of course, the OFHEO is the Office of Federal Housing Enterprise Oversight. To its credit, the OFHEO responded to revelations of fraud at Freddie Mac and launched an investigation of Fannie Mae as well. In 2004, OFHEO announced that Fannie Mae had also deviated from generally accepted accounting principles in order to conceal losses, reduce volatility and reported earnings, present investors with an artificial picture of steadily growing profits, and to meet financial performance targets that triggered the payment of large bonuses to its executives. The SEC conducted an independent review that confirmed OFHEO's findings of improper behavior, and within weeks, the leadership team led by Mr. Raines resigned from Fannie Mae. Fannie was forced to revise its earnings downward by $6.3 billion. OFHEO found that Fannie Mae's executives were precisely managing earnings to the 100th of a penny to maximize their bonuses while neglecting investments in systems' internal controls and risk management. The regulator found that earnings management made a significant contribution to the compensation of CEO Franklin Raines. Raines ultimately earned over $50 million at Fannie Mae, while Freddie Mac CEO Leland Brenzel earned almost $20 million in salary, bonuses, and dividends at Freddie Mac. The accounting scandals caused outrage on Capitol Hill and prompted members of Congress and the Bush administration, including Federal Reserve Chairman Alan Greenspan, to seek reform legislation that would have limited the GSE's risky mortgage portfolios and high-leverage debt issuance by empowering their regulator to require them to hold additional capital. In response, Fannie Mae and Freddie Mac sought protection from their strongest political protectors, the advocates of high-risk affordable lending. The GSEs essentially doubled down on risky, low-down payment lending to shore up support on Capitol Hill and fend off attempted regulation. GSE congressional supporters, many of whom sat on key committees charged with oversight of the housing and mortgage industries, made repeated public statements in support of the push to reduce the quality of underwriting at the GSEs and to block congressional efforts at better regulation. For example, at a hearing of the House Financial Services Committee on the GSE accounting scandals, Congressman Maxine Waters of California publicly praised the GSEs for implementing their affordable housing mission, a mission that has seen innovation flourish, from desktop underwriting to 100% zero down payment loans. And in a speech delivered at the swearing-in ceremony of the Congressional Black Caucus in 2005, Franklin Raines' successor, Fannie Mae CEO Daniel Mudd, sent a clear signal to congressional advocates of loosened lending standards that his company sought political cover in order to blunt efforts to address the serious structural problems posed by the GSEs. Mudd told the assembled members that he was humbled to reaffirm the friendship and the partnership between Fannie Mae and the Congressional Black Caucus, noted that so many of you have been good friends to Fannie Mae and our affordable housing mission. You've been friends through thick and thin. In reference to the accounting scandal, Mudd noted, "We have indeed come upon a difficult time for Fannie Mae. There is much to be done inside my company, and I humbly ask you to help us and to help me. If there are areas where we are missing, if there are areas where we could do better, we'd like to hear it from our friends, and I'd be so bold as to say, our family first. He noted pointedly that Fannie Mae has lent more money to more minorities and more undeserved individuals than any single company in history, and reassured members that you will see Fannie Mae reaching out and listening to the Congressional Black Caucus, and opined that you all are also the conscience of Fannie Mae, keeping us on course to serve those who need serving most. This speech by Fannie Mae's CEO reveals much about the unique relationship between the GSEs and congressional advocates of lower mortgage lending standards. The company was desperate to maintain its unfair competitive advantages granted by Congress in the wake of the accounting scandals and increased calls to strip it of some of those privileges. Its leadership clearly decided that the best strategy was to play up the politically popular, albeit short-lived goal of lowering their standards in order to increase the national homeownership rate and please their political benefactors. That the effect of this strategy was to trap Americans in unsustainable mortgages and feed the growth of a housing bubble merely heaped insult upon injury. Reform of Fannie and Freddie thwarted. For a price. The GSE's political risk management succeeded in thwarting congressional and Bush administration attempts at reform. In 2004, Senators Hagel, Sununu, Dole, and McCain took up Fed Chairman Alan Greenspan's call to create stronger regulatory oversight of the GSEs and limit the amount of leverage GSEs could use to invest in risky mortgage lending. While this would not have interfered with the GSE's role in providing a secondary mortgage market, it would have reduced their ability to fund high-risk lending with borrowed money and cut into the company's fabled profit margins and executive compensation. However, when the Senate Banking Committee took up the legislation, S.1508, Democrats and some Republicans opposed it as originally drafted. For example, the legislation was approved by the committee only after Senator Robert Bennett, whose son was employed by the Fannie Mae Partnership Office in Utah, attached an amendment that stripped the provision that would have allowed a new regulator to limit the GSE's leverage. This led the Bush administration to withdraw its support from the weakened legislation, which ultimately failed to pass the full Senate. A similar scenario unfolded in 2005 when the senators reintroduced their GSE reform language. Once again, the bill, S.190, failed to get a single Democratic vote in the Banking Committee. Among the Democrats who voted against the bill were Senator Christopher Dodd, who received a sweetheart mortgage from Countrywide, and Senator Charles Schumer, who had so prominently advertised a $100 million Freddie Mac affordable housing program in his state. Without any Democratic support, the legislation failed to garner sufficient support for a vote on the Senate floor and was never enacted. The House of Representatives also took up GSE reform in 2005 with the passage of H.R. 1461. However, the legislation did not allow the new federal regulator it would have created to limit the size of the GSE's portfolio. As a result, the Bush administration, citing Fed Chairman Alan Greenspan's insistence on the need for such a measure, once again withdrew its support, and the bill died. In return for political protection from oversight and reform, however, Fannie Mae and Freddie Mac were forced to placate their congressional protectors with an ever-increasing commitment to high-risk lending. That Fannie and Freddie felt such political pressure is made clear in an email exchange at Freddie Mac regarding the company's decision to not place an upper limit on the number of defaulting affordable loans the company was underwriting. Freddie Mac's senior vice president in charge of its affordable housing mission admitted that the higher default rates typical of lower quality affordable mortgages could do serious harm to households and neighborhoods. This grim reality notwithstanding, tipping the scale in favor of no cap on defaults at this time was the pragmatic consideration that it would be interpreted by external critics as additional proof that we are not really committed to affordable lending. Clearly, the GSEs feared a backlash from powerful advocates of looser mortgage standards so much that they could not even agree to place limits on how many defaults they would tolerate for one of their more risky loan products, irrespective of the obvious damage this lending was doing to families and neighborhoods. Politicians who favored reducing lending standards in the name of increasing the homeownership rate among their constituents cheered on these efforts. For example, members of the Hispanic caucus in the U.S. House of Representatives formed a special housing initiative called HOGAR to encourage increased lending to Latino borrowers in their districts through reduced standards. These lawmakers received financial and policy support from the subprime lending industry as well as from Fannie Mae and Freddie Mac, which in return received congressional support from their drive to make low-quality loans. According to one report, for $150,000 in campaign contributions a year, subprime lenders could supply a research fellow to produce studies for HOGAR that would in turn be used by industry lobbyists to push low-quality mortgage lending among Latino borrowers. For $100,000 a year in donations, the congressional group offered to provide news releases from the Hispanic caucus promoting a lender's commercial products for the Latino market. Freddie Mac partnered with HOGAR to produce a study of Latino home ownership in 63 congressional districts, which found that Latino homeownership had increased thanks to new flexible mortgage loan products, and recommended further easing of down payment and underwriting standards. Indeed, according to the U.S. Census Bureau, Latino homeownership increased by 47% during the housing bubble, from 4.1 million to 6.1 million between 2000 and 2007. This was an astonishing rate of increase at a time when the national homeownership rate rose by just 8%. Along with political pressure from Congress for more low-quality affordable housing loans, Fannie Mae and Freddie Mac also caved into the temptation to lower their standards in an attempt to take market share away from Wall Street. This pressure amplified the effect by the push by politicians to lower their underwriting standards in order to do more risky affordable lending. These dual pressures were noted in an email from Freddie Mac's chief risk officer. The push to do more affordable business and increase share means more borderline and unprofitable business will come in. The best credit enhancement is a profit margin, and ours is likely to get squeezed as we respond to these market pressures. But even as Fannie and Freddie acted to placate political allies, who they needed to help thwart reforms, some GSE employees were beginning to develop a new fear. A Fannie Mae presentation obtained by the committee explicitly acknowledged conditions indicative of a housing bubble, including an overheated market and the proliferation of increasingly risky mortgages. When faced with the choice of staying the course or meeting the market where it is, the presenters recommended developing underground efforts to delve into subprime and alternative markets in order to avoid becoming less of a market leader. One case study that illustrates the dual pressures of the politicization of mortgage lending and the push for market share is the internal debate at Freddie Mac over its purchase of no-income, no-asset, or NINA mortgages, a type of Alt-A loan. These risky loans did not verify a borrower's income or assets. The company's chief risk officer warned his fellow executives in 2004 that the mortgages in question would prove to be dangerously risky, and that Freddie Mac would likely give in to the temptation to continue lowering its standards to attract market share. In 1990, we called this product dangerous and eliminated it from the marketplace, he wrote to his colleagues. He also warned that these mortgages were disproportionately targeted towards Hispanics, making the potential for the perception and the reality of predatory lending with this product great. He also predicted that these loans were going to borrowers who would have trouble qualifying for a mortgage if their financial position were adequately disclosed, with first-year delinquency rates ranging from 8% to 13%. However, according to another executive, the company pushed ahead, buying billions of dollars worth of these loans to ensure we hit share objectives and continue to diversify our customer base. Freddie Mac executives sought to control the risk of these junk mortgages by implementing certain minimum parameters such as buying loans made to borrowers with at least a 680 credit score. However, in a nod to the competitive pressures of the market, the chief risk officer warned that we have already had requests from JP Morgan Chase and Wells Fargo to allow this offering to go to 660, and that competition between Fannie and Freddie will likely compete the borrower profile down to a level where understanding income and assets really does matter. I don't know how to put the genie back in the bottle. He continued, I know this is where the market is evolving. Having said that, we did no documentation lending in the late 80s and early 1990s, took inordinate losses and generated significant fraud cases. I'm not sure what makes us think we're so much smarter this time around. Another Freddie Mac executive admitted that pressure to reduce underwriting quality and purchase these loans was largely driven by a need to allow lenders to compete with reduced documentation mortgages at Countrywide and Bank of America. At the same time, the chief risk officer also acknowledged that the push to do more affordable business and increase share means more borderline and unprofitable business will come in. So in any case, everybody of a certain age should understand the precise implications of the housing crisis and the crisis of 2008. What I want to emphasize to everyone is the connection between the 2008 crisis and the current corporate hiring situation. Realistically, all of these policies are done to benefit the groups inside of the Democrat coalition. Everybody understands this. But once the powers that be see that a possibility of reform comes, instead of allowing for natural reform, the incentives financially ensure that they will double down, and that inevitably they will attempt to use their strongest support base, in fact, their most diverse support base. We have heard the word diversity many, many times before, and you can see in this report that that is certainly the case. So the problem with all of this is that with the hiring of non-whites in corporations and in the giving of non-whites a lower interest rate than whites in terms of housing again, what exactly are we going to see? We are not going to see another crisis of a similar magnitude as 2008. In fact, it's actually going to be much worse. Not only will you have the possibility of yet another style of housing crisis, but also a competency crisis on top of that. Connecting the exact mechanism here of the powers that be, and that is in terms of financial reform, that's in terms of housing reform, that's in terms of state-backed corporations, and the behavior of these corporations doing exactly what power really wants them to do, which is to ensure economic concessions and gimmies for the support constituencies of the Progressive Coalition. Really, all of these things do go together, and they're a similar policy. But I want to emphasize the exact mechanism here. Really, what you see is there's corruption, and they were always doing this to ensure that these groups were getting a gimme in addition to everybody else. But once people understand that the system is corrupt on a financial level, once the economics start to be understood and start to be talked about again, and reform comes down the road, the powers that be use diversity as a mechanism to avoid the possibility of reform. It is strengthening one's support base. It is running to one's strongest supporters and ensuring that you give extra goodies to those supporters in a moment of crisis, so that you can sidestep the possibility of any reform. However, as we saw with 2008, this does not work in the long term. It always falls on its head. It always falls on its face. So what can we expect from the corporate hiring? Well, this means that reform was indeed asked. We can tell with the destruction and getting rid of affirmative action policy in terms of slight reform, that the powers that be are now attempting to get around that by implementing all sorts of alternative measures in the hiring process and using things like ESG, things like these corporate hiring practices and social pressure and financial pressure, etc., to enforce corporations to hire only the people of their support groups. However, that too will ultimately fall flat on its face, as 2008 and Fannie Mae and Freddie Mac fell on its face in that period. So realistically, what this represents to me is not just the regime doing what the regime always does, but the regime using and performing really a rearguard action to sidestep the possibility of having to make any sort of political concessions at all, and keeping its grift going. Really, it reminds me of the movie I'm All Right, Jack, where a union man sees that the Capitol executive and the union man are in cahoots, and that really the only thing those two can agree upon is keeping the grift going and keeping the game going. So I think that that's basically what's happening here, in very clear terms. That's it for today. I just wanted to impress on everybody that this stuff is not new. It's happened before, and it's happened within the last 10 years. And we'll see what happens with the regime, but it'll take a couple years to continue, but I think it will ultimately collapse on itself again. With that said, please be sure to like my videos, like, share, subscribe, hit the notification bell as per usual, so that you get notifications. And when you, or if you would like to patronize my channel, you can sign up to my paid Substack. I will always put my Substack articles on whatever I'm working on my actual page there. And you can support me financially through Substack by subscribing to Substack, or you can give me a one-off donation through Buy Me a Coffee. So please help me out there. Have a wonderful day.